Hi, Sebastian from Eagle High Plantations. Want to show you how to make some calculations like last time. So last time we didn't have the first quarter results yet, and we made a prediction using our data file, which is on the website. We worked out volume was down 8%, price up 25%. So the sales should be, or should have been, about 16% higher. So that's what we predicted the sales, and then to get the cash costs, we used the full year number from the fourth quarter. So net profit, add back depreciation, take out the biological and minus from sales. So that's a year's worth of cash costs. And then to get EBITDA, we added back the interest, about 800 billion, and then we divided that by 4 to get quarterly, and then to calculate the EBITDA we can just take the cost from the sales. So that's what we had predicted before, and then now the number's out. This is the EBITDA, operating, add back depreciation, take out this non-cash biological. And you can see we were almost perfect. The number was 210, we predicted 208, and we said the EBITDA was going to jump, which is exactly what happened. So that one worked out very well. And we also did a calculation for the production. So if we take the fruit production, May was pretty low, because a lot of holidays this May, and we used the weather. So the fruit is affected by the weather about 6 or 7 months before, so we can use the rainfall in here. If we go back to October and use an average, and then let's go back. So if we add in this to the chart, put it on the right axis, you can see the rainfall is a pretty good predictor. Just change that, adjust the scale a little bit, and there you go. So you can see it's been a fantastic predictor of the fruit production. So last time we did this also, we showed that if you take the next 6 months, then we should be at the low, and the fruit production should jump over the next few months, almost double. So how about the price? Well, we can use another tool to project the price. So here we've got the palm oil price, which I put in ringgit thousands, and we've got the Malaysian palm oil inventory. Monthly data going back to 2015. I saw this as an idea from a palm oil publication called Palm Weekly. So if we look at the relationship between the price and the inventory, not surprising, it's a pretty good inverse relationship. So inventory up, price down, and vice versa. But in order to make this a bit easier to read, let's make the inventory match with the price, like this, like magic. So if we put that all the way through, so the inventory is up to the end of April, and we change the scale here a bit. So this is in thousands, remember? And then let's make that. So you can see the inventory is projecting that the price should be above 3,000 ringgit. So the price is rising now, and unless there's a major change in the inventory, hopefully we're going to be targeting above 3,000 ringgit. So we've got rising production volume, rising price. What would that price mean for us? Well, if we look at the cash flow, we can work out what is the cash cost. So we've got operating cash flow minus the receipts, and we're going to add the investment spending. So this is all the cash outflow. Okay, and we can divide that by the production, and up here we have the oil production. Just make that into thousands to match. So there we have the cost per ton. This is the cash cost per ton. Alright, and if we take, obviously this goes up and down, but if we take the average of the last few quarters, so it's a reasonable average, that's the cost. And if we put this in ringgit, so it's about 3,400 ringgit to the rupiah, that is the break even, and we need to add 10% because the price has VAT included. So the break even is 3,000 ringgit. So if the price goes above 3,000 ringgit, we would be making money, which we haven't been up until now. That would mean that the debt would be coming down. Probably that would be seen as a good thing for investors who might get quite excited. And let's just say, for argument's sake, that shares, when they are losing money, tend to trade below the book value, and then when they're making money, they trade above. So right now, if we look at our net asset value divided by the number of shares, then that would mean our shares should be above 140. Right now they're 80 to 90. And that's how to make the calculation. You can do it for yourself, get the file on the website, and that suggests that we will have higher production, higher price, EHP will make money, and BWPT should rise above the book value 142.